Hello everybody, Tortoise Investing coming at you today with 3 of the best stocks to buy now. These are ones that I feel are at a pretty great entry point. Always do your own research and see if the stock fits your portfolio and investing needs. Don't just buy them because I'm recommending them. I just like them at current values. Now, if you're new, you like top stock to buy now list, best ETFs, I do things like this weekly. I would greatly appreciate it if you would drop a sub and a like down below. Those two things help the channel and the videos out a ton, and I greatly appreciate it. Happy 4th of July, everybody. Here's my portfolio. Take a quick look at that before we look at the stocks we're going to be taking a look at today. So a little bit over $700 now. Overall yield of the portfolio is 0.71%. Slowly growing over time. I know it's not much right now. Had a lot of stuff go on. Paid off pretty much all my debt. And I feel that was worth it. And going forward, I'm going to be able to hypercharge and rebuild this portfolio into something phenomenal going forward. And I think it's interesting because you're going to be able to see me build this from the ground up, and I show my portfolio off in every single video. So this is how things are looking. I'm pretty happy. Portfolio full of what I would refer to as winners. But let's take a look at what we're going to be taking a look at today. First up, we got MasterCard. Love this stock, especially under $4.50. I'm looking to add to this tomorrow. I get paid tomorrow. Just free cash flow yield 2.54%, dividend yield 0.59%, and payout ratio 19.55%. So nice and low payout ratio. Take a look here over the last 5 years. Up 64.69% over the last 10 years. 488.32%. That is amazing. And you know what? I think that there's plenty of growth left in this beast. Revenue grown at a rate of 11.64% over the last 10 years. Absolutely awesome. As if you see here, the total MasterCards is just continuously rising year over year. Just up and to the right. It's one of the most reliable things in the world. Visa's another one I would put right here side by side of MasterCard on just how great it is as a company. I just like MasterCard a little bit more. Free cash flow, 11.71%. Very nice. Very, very nice. And the EPS growth, 16.54%. Growing EPS, a growing company. Love to see that. Their debt, let's take a look here at the quarterly so we can see it updated. Debt is $13.54 billion. They have $7.66 billion cash on hand, and their EBITDA last year was $15.35 billion. So my rule of thumb is I don't like to invest in companies that have more than 3 times their debt, 3 times their EBITDA in debt. That shows me if they were to have some financial hardship, something bad was to happen, and they needed to take out debt, it's going to hit them a little bit harder. But this is a very healthy balance sheet. The dividend growing at a rate of 19.62% over the last 10 years. That's just crazy. Look at that. It's like a big old set of stairs. This is compounding at its finest. You're going to be getting those dividend hikes. You can roll those dividends into buying more shares. And then year over year, you're reliably going to be getting that dividend increase. Love to see that. Shares outstanding. Another thing that I love that MasterCard does, they use their excess cash flow to buy back shares at a rate of 2.47% over the last 10 years. This is dropping like a rock. As of 2023, it was 946. Let's take a look at the quarterly. We are setting at 935, so they are still buying back those shares. Love that. Return on capital employed is nuts. Usually company averages around 9 to 10%. This is 55.56% of last year. You could cut this in half twice and still be beating most companies. Crazy. Absolutely crazy. EPS, 14.29 growing to 16.57 from this year to next year. Looks pretty good to me. That's double-digit growth. And revenue, $27.83 billion for 2024, growing to $31.28 billion in 2025. Again, if I'm mathing right, it's over 10% growth as well. Next up, Starbucks. I know a lot of people are hating on the caffeine sector right now. I'm drinking me a Celsius as we speak. I'm investing in Celsius as well. Don't buy it because I have it. Just free cash flow yield, 4.21%. Dividend yield, 2.99%. Payout ratio, just below 62%. Take a look here at past performance over the last 5 years. Down 13.13%. And over the last 10 years, up 93.8%. So, again, pretty good performance over the last 10 years. Got to be looking, you're getting that dividend as well. Revenue, growing at a rate of 8.14% over the last 10 years. Very nice and reliable. The thing that kind of scared people was their 90-day reward members kind of dropped. Because beforehand, it had been going up, and it had this little dip. And I'm going to just say that this is probably more of a political dip than a performance dip. I know that it's been a crazy 2 years with like the unions and then just a lot of like personal things being in there. But you know what? That's not going to scare me away from a moat in a strong company. This is another one that I am looking to add. I think this is going to be a winner in the long term. Total stores. This is growing up and to the right as well. Very, very nice. They are trying to really focus in on China. I know a lot of people are afraid of China, but it's one of the most populated places in the world. It is the most populated place in the world. I think there's over 2 billion people there. And, just flood that place with stores too and just rake in that money. Free cash flow is something they could work on. It's a little bit... It's growing, but could be growing a little bit more. But you know what? I ain't going to hate. There's no big negatives here or anything like that. No big, huge, scary drops. EPS growing at a rate of 10% over the last 10 years. Very nice. The debt, take a look at the quarterly so we can see updated. $15.55 billion. They have a little bit over $3 billion in cash on hand. Their EBITDA last year was 7.33, still falls under my parameter, not more than 3 times the EBITDA. The dividend has been growing at a rate of 15.93% over the last 10 years, but here lately, about 7 to 8% of those dividend hikes. Still perfectly fine because you just don't want something that's only been growing like 1 or 2%, because then inflation's going to be eating into your dividend growth, and it's just not good in the long term. But if you have something like inflation's 3%, your dividend's growing at 4, 5, 6, 7%, you're definitely going to be raking in those benefits. Shares outstanding, let's see here, they were sitting at 1.14 billion as the end of last year, 1.15, so they are slowly buying back shares still yet. At a rate of 2.78% over the last 10 years. And I hope that they are taking this dip right now and was taking advantage of it back here as well, to just everything that they have extra, just buy back those shares, throw that money, throw your cash at it, do what you got to do. Just don't take out a whole bunch of debt. No one likes that. And just use your extra cash flow to buy back those shares. That would be amazing. And return on capital employed as of 2023 is 29.21%, which is very nice. EPS, 2024, estimated to be at $3.60, growing to $4.21 next year. That is some double-digit growth. Very nice. And revenue, $36.82, growing to $39.97. I think that is also right at 10%, if not is 10%. So again, very nice, big moat, very reliable, growing revenue, and they got a fan base. Like, you got those Starbuckers. It doesn't matter what it is, how much it is. Oh, I got to sell my house for my coffee. I'm going to do it. That's like, some of them are dedicated to it. They're every day. I have Starbucks every once in a while, kind of as a little treat to myself. But there are a lot of people that are just day in and day out. They have got to have it. Lastly, Ulta Beauty, not a dividend payer, but I still think it is a great compounder nonetheless. Just free cash flow yield of 4.59%. Take a look here at the chart. Over the last 5 years, up 12.96%. Not a lot of growth for the last 5 years. Over the last 10 years, 305.91%. That is what is up. That's awesome. Now, revenue, 15.42% over the last 10 years. Very nice. Number of stores also growing. Very, very nice. Like to see that. The cash flow, 26.19%, 10% over the last 5 years. Very nice as well. They buy back shares. I like that. I like that a lot. EPS, 23.51%. Again, this is just very reliable up and to the right. And they do have a little bit of debt now. $1.63 billion. Their EBITDA was $1.94 billion. So no red flags there whatsoever. Shares outstanding. They buy back those shares. I can tell you that right now. They gobble up those shares. 48.38 million shares outstanding as of right now. And if we take a look over the last 10 years, at a rate of 2.59%. And over the last 5 years, 3.8%. So it has been accelerating. Love to see that. I'm hoping right now, same situation with Starbucks. They had this big dip here. And I hope that they are taking advantage of the moment, buying back those shares at lower prices. And return on capital employed, very same situation as MasterCard. You could cut this thing in half twice and still be above 10%. That is just awesome. Very reliable return on capital employed. They know what they're doing. Look at that share count going down. Look at that EPS going up. Look at that revenue going up. Very strong company. EPS, 23.13 growing to 25.77. Again, pretty nice growth there. I don't know if it's supposed to be 24 or not. It says current year. I'm going to assume that's supposed to be 24, so double-digit growth. Revenue, $10.01 billion growing to $11.56 billion. Again, double-digit growth there as well. So that is the 3 best stocks to buy now. I hope that you enjoyed that. Do you own any of these? Let me know down below. I greatly appreciate it. And until next time, take care. See yous.